Great, thanks Roland, and thanks everyone for turning up. Really welcome opportunity to present the Schroder European Real Estate Investment Trust. It's a trust that I've been working on actually since the IPO, which we did in December 2015. And just to sort of give you the macro and the micro as to why we set this up, the macro was to pick growth or winning cities that we believed would grow faster from a GDP, a population, or an employment perspective. And then the micro is actually we've got teams on the ground that can pick sub-markets that will benefit from, for instance, transport infrastructure changes, where there's competing demands for uses, where there's supply constraints, where we can create value, and where we're actually fundamentally buying buildings that are leased off affordable rents. The sector at the moment, as plenty of you will realise, has been sort of struggling and been probably heavily oversold. And I think hopefully at the end of today or tonight, you'll walk away from here understanding that this is a compelling investment case. It's a unique proposition. It's the only UK-listed European trust that gives investors exposure to a diversified portfolio across some Tier 1 cities that include Berlin, Hamburg, Stuttgart, Frankfurt and Paris. It's diversified in terms of the sectors that or the assets that we've invested in. So we've got about a third of our exposure in offices. We've got a third in industrial. We've got about 17% in some select retail. And we've got some alternatives, and we're sitting on quite a bit of cash at the moment. One of the real nuances that go with European investing or European leases for real estate is that the leases are typically 100% indexed to inflation. That's very different to what one gets here in the UK, where they're typically 5 yearly to market. So given that we've been dealing with some inflationary concerns, that's been coming through the income profile and giving us some growth going forward. I touched on before about the cash position that we have. We decided about a year ago to go very conservative, and as a fund manager, I feel really comfortable about being in the position that I'm in at the moment. I'd hate to be running a vehicle that was massively over-levered. Our leverage at the moment, net of cash, is about 24%. Puts us in a really strong position now to where can we take the vehicle, whether we look at investing in the portfolio to improve the quality, whether we look at some new acquisitions, but obviously trading at a 40% discount at the moment, there's also an opportunity to maybe look at a bit of a share buyback as well. Just on that, extremely compelling buying opportunity. For those coming into the stock today, you can buy the shares at early 60p. That gives you a dividend yield of 8%. You're getting a 40% discount to net asset value, and I'll come on to that point a bit later. And that dividend is 108% covered. So if you look at the last 9 months of earnings, you're getting 108% cover, so there's a bit of headroom there. And then with Schroders, and this is probably something I should have touched on earlier, I mean, massive business. So real estate is a relatively small part of the broader Schroder business, but I sit with a team of nearly 300 investment professionals. And the locations that I focus on from an investment point of view is really France, Germany and the Netherlands, and a large part of our teams are located there. And we typically run our teams as specialists. So although I'm a diversified investor, I've got specialist office investment professionals, I've got specialist retail professionals, specialist industrial professionals as well. And we've got a very, very big hotels team across the business as well. Just to sort of run through, and I won't touch too much on this, and I haven't sort of gone in and spelt out the different diversified investment trusts in the UK here, but I just wanted to sort of highlight actually we stick out not only in terms of the strength of our dividend yield at the moment, but also the cover that we have. I mean, there's not really another group there that has as strong a dividend cover and delivering as strong a dividend yield as what we have. Equally on this slide, and you can take this away when you look at the deck yourself, but where you want to be here is in terms of the bottom, so the lowest LTV. Okay, so we're pretty well the lowest vehicle across the 25 trusts that are listed here in the UK. Yet we're showing one of the strongest dividends, we're showing one of the best dividend covers, yet we're trading at a 40% discount. And I think investors are missing and not really getting under the bonnet and really understanding some of these trusts that are out there. And I get the point that if you're massively over-levered, you should be trading at pretty deep discounts. If you're heavily focused on office exposure, you should be trading at a pretty heavy discount. But if you're diversified and you're in the right cities and the right sectors, there's a lot more conviction there that one can have in terms of where that pricing is. So it wouldn't be a real estate presentation without showing you some photos. And I get quite excited about the top left here. I'm not going to go through every asset, but the reason I get excited about the top left is, although it's classified as a retail asset, I'm sitting on 4 hectares of land in Berlin. And for me, that's an opportunity to use that land to a higher and better use. I've got a tenant in there, which is Hornbach, which is the leading DIY specialist. They're trading their head off. The pandemic was a huge success for them because everyone was sitting at home investing domestically on their own home. So DIY type operators have done really well. They'll probably stay there. They've got 3 5-year options. They'll just stay there. I'm in a capital city. I'm on the 4 hectares. The big play here is that we can change the use of that and get planning for a mixed use. So I'm happy to take the income on that, but with the view that actually longer term I can turn that into something else. Equally, I've got another retail asset in Frankfurt. It's a grocery anchored scheme. It's in a very strong urban, densely populated part of Frankfurt. I've got Lidl as my main tenant. We're just about to secure Lidl again on a new 15-year lease. We're seeing a lot of activity in terms of on the investment side for these type of assets. They're very, very liquid, particularly from high net worths, private individuals. So one of the things we may be looking at doing is actually testing and looking at selling this asset. It's a relatively small asset, but if I can sell this at a premium to NAV, given I'm trading at a 40% discount, it just makes a lot of sense to use that capital to possibly do that small share buyback that I touched on. Obviously on the industrial side, again, a sector that's been a beneficiary of the pandemic. We're seeing a lot more growth in terms of e-commerce, and on the back of that, logistics assets are booming. Equally, on the manufacturing side, we're seeing a movement away in terms of manufacturers moving away from China and looking at sort of onshoring, and parts of Europe are benefiting from that as well. So we've done well in terms of pivoting out of some retail pre-pandemic and buying some logistics assets across France and the Netherlands. And then in the offices, I mean, offices are a very, very heavily debated sector at the moment. And I've got 3 office investments, 2 that I actually think are exceptional and 1 that is a challenging asset. I'm very open to talk about the risks that we have and how we manage the risks. Now, the 2 decent assets from an office point of view that I feel really comfortable about are the 2 in Germany. Hamburg, I've got a fully occupied multi-tenanted office building, 1 stop from the city centre. I'm off rents there that are a third of where prime rents are in Hamburg, so I feel very, very comfortable about being able to maintain that occupancy. Interestingly, it was a building that coming into the pandemic, I had 5 vacant office floors. I leased every one of those floors within 6 months of the pandemic because occupiers wanted to have a location that they could get to that was accessible and that was affordable. It's not the shiniest building. It's a grade B building. It's not a grade A building, but there's occupiers out there that are happy to take that. As long as they can get their teams to the building, if they're only coming in 2, 3, 4 days a week, they don't want to pay the highest rents. So this is the type of building that actually has performed exceptionally well. Equally in Stuttgart, I've got the government in this building. It's an asset that's in the city centre of Stuttgart. Stuttgart has the record lowest level of vacancy in the whole of Europe, 2%. There's just no choice for occupiers. Again, it's a building that's leased off rents that are about 40% of where prime rents are. So it's a building that if the government wanted us to improve and take that to a grade A asset, we could do that, but we'd move the rents accordingly and pay for that. So I feel really comfortable about having exposure in those offices, in those really strong cities. The asset that's going to be bumpy is the asset that we have in Paris. And the reason it's going to be bumpy is it's SME businesses that are in this. I've got 85% occupancy, I've got about 15% vacancy. These businesses typically only sign 3-year leases and are often sort of moving around. So that's an asset that will continue to be heavily managed from an asset management point of view. I spend quite a lot of time with our teams in Paris on that. It is reflected in the valuation because it's valued off an 8% net initial yield, but it is an asset that is probably not the most liquid asset today. If I had to sell that, I don't think there's that many buyers. The reason we bought that asset is because there's going to be a train station come outside that building. It was meant to be in 2026. It's now been deferred to 2030. So we'll get some positive reversion or ERV growth on the back of that. I'm off rents of low 200 euros a metre. To put that into perspective, prime rents in central Paris are 1,000 euros. Prime rents in this location are $450. So as a back office location, this still competes, and we're seeing occupiers wanting to be there. We just actually did another floor in the building at a rent of €230 a metre. So there is activity, we are getting people there, but it's just going to be an asset that will continue to be bumpy. And then the other asset we've got is an alternatives asset. It's a data centre in the Netherlands leased to KPN. So KPN is the leading Dutch telecommunications company. We're in discussions at the moment, still a little bit early. Their lease expires in 26, but about trying to retain them. And that's a key focus for me going forward. So that's the portfolio. Trying to sort of whiz through just on liquidity. What we're seeing in the markets at the moment is the bigger assets not selling. So anything that's 50 million to 100 million, there's just no liquidity. As you've seen, we've focused on asset sizes that are in the 10 to 30 million. That's where most of the liquidity has been happening. So I feel comfortable that if I had to sell the assets, I would be able to sell those pretty quickly and at prices that reflect the values that we're holding at. Just a little bit on where yields are and actually relative to where risk-free rates are. So typically real estate is traded at about a 200 basis point premium to where the risk-free rate is. You can see here the underlying portfolio varies across the different sectors between 200 and 400 basis points. Take out the data centre because that's valued very, very specifically at the moment because the valuers are saying it's a depreciating asset until we've actually re-geared the lease with KPN. They're just going to value that as remaining income plus land value. So that's a conservative valuation in my opinion. Just really, really good example. So best case of where we as a manager can create value. So we took an office building in Paris that was a tired grade C office building. It was worth 40 million. We knew we had to do something with it. We had a single tenant in there. We said to them, we're going to turn this into a grade A building, but we need you to stay for 10 years. They said, yeah, happy to do that, but equally we need you to move your rents accordingly. We then invested 30 million, so we were in for 70 million. At the same time, we agreed a forward funding sale at 100 million. So we took a grade C asset, turned it into a grade A BREEAM rated investment and created 30 million of pre-tax profit for investors, and that allowed us to give some special dividends back to shareholders through 2022. So that's now sold. We've got about 1 million left of the profit still to come through our NAV, but just a really good example of how, as a manager, we can de-risk an office building, our relationships with tenants, how we provide solutions to tenants, how we can create value for shareholders. Got some smaller examples looking forward. Probably the biggest one is the KPN, the data centre that I touched on. Longer term, we've got the St. Cloud with the transport infrastructure and Berlin with the 4 hectares that I touched on before. Inflation, important point. I did open up with this as a bit of a nuance, but again, there's a bit of juggling as to where inflation is going to be landing. It's come back quite heavily. I mean, in the Netherlands, we had some leases that were expiring or were due for a rent review and indexation in January last year. The index at that point was 14.5%. So we sent letters out to those tenants. Their rents went up 14.5%. Now, thankfully, that's come back a bit, and we're now dealing with sort of low single digit in terms of indexation. But going forward, that's probably going to be somewhere around sort of 2 to 4%, depending on the jurisdictions that we've focused on. On debt, again, a very topical point for real estate at the moment, and those vehicles that are over-levered are going to come up with some very, very sort of difficulties in refinancing. Banks are getting much more focused on not just the quality of the asset, but also the counterparty that they're lending to. So someone like a Schroder's is seen as a very strong counterparty, and we've been able to de-risk the debt. As an example, we raised some debt against the 2 office buildings in Germany. We did that at a margin of 85 basis points. So at the time when we did that, we locked in the 5-year swap, which was 2.95%. So it gave us an all-in cost of debt of 3.8%. That particular lender gave us that money with no covenants, which is an extremely unheard of position to be in. We decided to actually increase our gearing on that from 14 million to 18 million, use the additional 4 million to repay a small loan that we had in France. So just good capital management. Roll forward, in the Dutch logistics, we changed lenders. We moved to ABN. We kept the same gearing. It was a little bit more expensive because the margin on that was 200 basis points, and at the time we secured that debt, the 5-year swap rate was 3.3. Today, the 5-year swap has come down to 2.7. We've just done another refinancing in Rennes in France. That matures in March, but we've just actually agreed that now for another 5 years. I came out with an RNS 2 days ago on that. The margin on that now has gone to 1.6%, so from 1.4 to 1.6. So we're in a really strong position in terms of how we've de-risked the refinancing risk that we have. We have got a loan here against Seville that is in breach, and we're in the position where we can actually hand the keys back to the bank because all of our debt is non-recourse. So if something goes wrong, we're in that position where we can actually give the asset back to the lender. In this particular instance, it was an asset, a shopping centre that didn't survive the pandemic. We were very quick to write the equity position on this to nil. So there's nothing in the NAV on this, but we are reflecting the liability from an LTV point of view. So if we hand the keys back to the bank, our gearing falls by about 3%. So we go from 33 down to 30, and if actually net of cash, we go from 24 down to 20%. So a really strong position to be in. So in summary, it's a really compelling investment case, particularly for those investors coming in today. Being able to buy the shares at early sort of 60p, you're getting a dividend yield of 8% with a cover of 108%. You've got that discount of around 40%. We're in the right cities that we believe are going to grow going forward. We're diversified. We've got angles where we can actually sell some of the retail. We might look at selling maybe an office building, quite like the industrial allocation that we've got. With the capital that we've got at the moment, the cash that I touched on of around 27 million, we're looking at, and we're in the process of finalising sustainability audits across the portfolio in terms of ways that we can invest in the portfolio to improve the quality. And there's ways there that we can grow earnings through making that investment rather than running out and just chasing income and buying new acquisitions. We're seeing an opportunity to actually invest in the assets to not only improve the quality but also the liquidity from an investor point of view, an occupier point of view, and also to the lenders as well. And I think just finally, and I know I touched on it in the outset, but that's the team behind me. So I'm the fund manager, been with this vehicle since day dot, but these are the team members that I work very, very closely with, and again, the specialists that we have on the ground in the jurisdictions that I focus on, which are primarily France, Germany, and the Netherlands, and spend a lot of time with those teams. Obviously, we have a real estate investment committee as well, and then a board, and some of those members you may have come across in your time. So I'll stop there. I think my allocation of time is over, and happy to answer any questions you've got.
Jeff, thank you very much. A question right away there, and then we'll come to you next, please.
Is a US-style meltdown coming in commercial real estate in Europe? And if not, why not? What's the difference between Europe and United States?
Yeah, so it's a very topical question. I mean, Europe's very different to the US. When you think about urbanization and where do people live. So across the European cities, most people live in the city centre. So you can actually get to the office building. Whereas in the US, a lot of people live away from the city centre. They live in their big homes, they've got big studies, transport infrastructure is not as good, they're driving their cars. So there's a big impediment for the US to get back to the office. Okay? On the continent, we're not seeing that. Okay, saw some statistics the other day where actually, for some of these cities, we're back to pre-pandemic office space use. It's also very different here to London as well. I mean, London's probably a little bit more like the US because a lot of people are commuting into London. But if you think about the cities that we have invested here, particularly Hamburg and Stuttgart, most people live in the city centres and can get to the office buildings. So that's the key difference. The other big point is we haven't seen the oversupply that the US have seen. So you don't have vacancy rates of 30, 40% like you do in San Francisco. Okay? Banks, occupiers were much more prudent post-GFC about not wanting to lend on speculative development, not wanting to take too much space. So you saw the demand-supply equilibrium in much more balanced, and that's why we're in a healthier position than what the US is at the moment. And I touched on before about Stuttgart having 2% vacancy in the whole market. I mean, you just can't go anywhere. The other thing that we're seeing is obviously construction costs increasing. So you can't just go and build. And if you do build, you've got to, in terms of the justify construction, you've got to move your rents up. So again, existing assets are looking far more compelling relative to new construction as to where rents need to be to justify that. So that's my sort of position in terms of why European cities will not face the difficulties that US markets have faced.
Gentleman here, the blue jumper. Thank you.
Yeah, hi, Jeff. First, two questions. First, what's the valuation procedure, i.e. the frequency, the assets, and who does it?
Yep.
So and then a technical, sorry, just another question. When I saw you last, I think you should have checked this, you had some shares quoted in South Africa, and there was a bit of a share flow back. Could you just update us to what that situation is?
Yeah, happy to. So valuations are independent. They're done by Knight Frank, and they're valued every quarter. Okay, so Knight Frank have offices across the globe. They've got offices in the cities that we've invested in. So it's independent. They present the valuations to myself and the board. We typically come out with an RNS to try and give a steer to the market as to where quarterly values have gone. So in the next couple of days, actually, I'm coming out with that steer around Q1 values. So that's the process. I'm sort of tried to touch on before around where valuations are from a net initial yield point of view relative to where the risk-free rate is. And certainly that sort of gap of 200 to 400 basis points gives investors. Do everything. So do every asset on a quarterly basis. Your second question is about the secondary listing that we have. So when we did the IPO in 2015, we had a situation where there was a lot of capital out of South Africa that was wanting to diversify. It made a lot of sense. The rand actually was relatively strong. We had a very strong business down in South Africa, and we were able to raise 50% of the IPO out of South Africa. What then subsequently happened is that Ramaphosa came in, and there was a lot more comfort that investors thought was going to happen to South Africa, and they retreated, and we had this overhang of stock that we had to deal with. So the register went from 50% in South Africa to now single digit. And that register has now been picked up by a lot of the Irish, so we've actually diversified the register, which has actually been positive, but it was an issue. You're correct to raise the question. We have dealt with it now. The sellers out of South Africa have pretty well stopped. The question that I get now is actually, do we need the listing down there? It doesn't cost us much money. At the moment, we're going to keep it. But there is a point where if they continue to sell down, we'll probably close it.
Question here, please.
Thank you very much, Mr. Dwyer, for a very interesting and comprehensive presentation. I looked at some statistics before coming here to see that if I bought your company 5 years ago, I'd be roughly 20% down in capital terms, albeit having taken a dividend in the meantime. And that inspired me to look a little bit at the discount, to take account of that, but also the sector, and taking data from Citywire out of 36 companies invested in various aspects of property, including European. Over 5 years, only one sector made money, which was in logistics, and only one made money in the last year, and that was in medical properties, or properties with medical activities within them. My problem, therefore, seems to be as much with the sector as what you're doing, and that may be compensated by a discount, but I'm also looking at the discounts available in private equity, where the recovery profile for a narrowing of the discount seems to be more broadly spread and potentially lower risk if one's looking at the gap between those two things as a means of judgment for investment probabilities. I wonder if you could comment on the relative merits of those two sectors, accepting that within property your own performance, even though mine is 20%, sounds not particularly good, appears to be reasonable for its sector, shall we say. So I don't want to leave a completely bad feeling, but I'm concerned as an investor that this might be the wrong place to be, even if you do find the right person.
Look, I think it's the right place to be, and I think the discount at the moment has been oversold. And you want to be aligned with those companies that have modest gearing, that have teams that actually can manage the real estate risks. There's still some headwinds that we're dealing with. But if you've got those two things correct, I think you're going to be able to create value going forward. I mean, the difficulty of this vehicle, I guess, has had to date is that it's relatively small. Okay, so it doesn't sit on the radar of institutions, so it's more the wealth managers and retail, which is why we're sort of speaking and presenting to retail investors. To answer your question specifically on the industrial side, and it was an incredible position if you go back even pre-pandemic, there was a huge focus on investing in industrial. And we saw yields for industrial real estate at sub 3%. We didn't see any sense in that. Those particular specialists, and there's a couple of European industrial specialists, they've seen huge now re-ratings go the other way because those values have gone from being valued at 3% to now being valued at 4.5%, 5%. So that big yield differential has created a huge increase or re-rating. And if they're over-levered, let's say 50%, obviously it's magnified twofold. So we've never been a buyer of prime logistics. We've been buying sensible, good industrial real estate at between sort of 5.5 and 7.5 net initial yields. So I feel really comfortable about what we have. I can't comment on the healthcare side. That's not a sector that I cover. But in terms of I think being balanced and having those teams on the ground that can manage the individual real estate sectors is key, and that's where we can sort of grow this going forward. And I think the discount that's being applied to this particular trust at the moment is way oversold. As I've sort of spelt out, particularly given the leverage that we've got here and how we can now position the company with the cash that we've got.
Jeff, we've run out of time. Thank you very much indeed. That's great. Terrific. Thank you.